My name's Ethan Braid. Today we're going to talk about what happens when the Fed starts cutting interest rates. Typically, you get a recession. Let me show you some data so you can see for yourself what happens when the Fed starts cutting interest rates. This chart is the last 70 years of the interest rate that is directly controlled by the Federal Reserve Bank. We're looking at the federal funds rate. And what I want to draw your attention to is that over the last 70 years, there have been 10 recessions. The gray bands on this chart are all the recessionary periods in the last 70 years. And notice that when the Fed starts cutting the interest rate, that is typically when the recession begins. Take a look in the year 2000. Notice that once they started cutting, that's when the recession started. And then again, 2008, we're cutting rates, boom, recession. So the history is pretty clear. Whenever the Fed begins to cut interest rates, and especially if there's an emergency interest rate cut, the recession is about to begin or it has already started. All of the talk about soft landing, which I've heard before, by the way, in 2000 and 2008, is usually nonsense. Soft landings are very, very rare. Let me show you the one soft landing that has happened in the last 7 decades. The one soft landing that occurred in the last 70 years was right here in the 1990s. Notice that the Fed started increasing interest rates and then they stopped and we had no recession. That is the only soft landing in the last 70 years. Typically, the pattern is the Fed is raising rates until something breaks and we get a recession. Raising rates, we get a recession. Raising rates, we get a recession, so on and so forth. This pattern is very reliable. If we've only had one soft landing out of 10 recessions or 11 Fed funds increase cycles over the last 7 decades, your odds of a soft landing are less than 10%. Think of the economy like a 3-mile long freight train that's moving at 50 miles an hour. You can't stop that train in 10 feet. And that is why the Federal Reserve has had such a hard time creating soft landings. Their batting average is terrible. Out of 11 federal funds rate increase cycles over the last 7 decades, 10 of them have resulted in a recession in only one, the one that I showed you in the 1990s. That is the only time that the Federal Reserve increased interest rates and then stopped and created a soft landing. So I'm always amazed at the people who get so excited for interest rate cuts and for a soft landing. It's like a unicorn. You just don't see it very often. Again, I saw the same thing in 2008 and 2000 in the past recessions. People were very excited for lower interest rates and interest rate cuts, and they used that as a reason to bid up stocks, just like now, by the way. And then the recession came. So be prepared for what's likely to come. Related to the timing of Fed rate cuts and a likely recession is yield curve inversion as a recessionary indicator. What we're looking at here is the spread between the 10-year Treasury and the 3-month T-bill. Whenever the area of this chart is below 0, like it is right now, then we are inverted and a recession is probably not too far off. In this chart, you can see the last 8 recessions have been preceded 100% of the time by yield curve inversion. Every one of these recessions, we had yield curve inversion right before the recession. If we do get a recession, then the next decade or so for the S&P 500 is likely to look like it did during the late 60s to the early 80s, or from 2000 to 2013, where we had over a decade of no return on price. When we enter a recessionary period, your strategy for investments needs to change. What worked during the bull market is not going to work in the future if we get a recession. For example, just buying Apple and hoping that it goes up, or other large cap technology companies, the mega cap tech stocks, it's not going to work anymore. And here's some interesting numbers for you to ponder. In the year 2000, we had a couple companies that were worth over $500 billion on a $10 trillion economy. And it was a big deal. We thought that was concentration, right? One company market cap to GDP is 5%. And I'm talking about Cisco and Intel and a few others. Today, we have companies that are worth $3 trillion. NVIDIA, Microsoft, Apple. That's crazy stuff. And this is on a $28 trillion plus economy. So now the concentration is the most it's ever been in the history of the United States in a couple of names. It's wild, wild stuff. Think about it. Two companies, Microsoft and Apple, are worth more than 20% of GDP when you compare their market cap to GDP. So could you reasonably expect any of these companies to double or triple in the next few years like they have in recent years? Absolutely not. I mean, just think about it. If they go from 3 to 6 and 6 to 12, pretty soon those companies will be worth more than the entire economy. And that's why it's not going to continue, or it's going to really slow down. Something for you to consider, because as we move into a recessionary period, how you make money is going to change. You're going to need to focus more on making money from income, dividends, okay, and maybe from bonds and other asset classes, and not by buying stocks and hoping that they just run up in value. I think those days are over for a long time. You really want to think about it when you're reviewing your investment portfolio. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.